Good evening, ladies and gentlemen. Lovely to have you with me this evening, and it's good. Thank you. Mickey D's with us. He was here early today. He says you can hear me all right, so I guess the rest of you can. Norbert, lovely to have you with us, of course, and Trevor, Vicky in particular. Lovely to have Vicky with us. Oh, look, everyone's here. Chris is here, Colin's here, Greg Palladini's here, Hank down in the Hunter Valley's here. Good to hear from you, Hank. Jeff Connolly's with us, of course. Mark L. We can't have a tutorial without Mark. Look at this. Everyone's arrived at a running. Hello, mate. Yeah, thank you. Everyone's arrived at a great rate just now as I started talking to you. George is with us. Good to have you with us, George. Everyone. Wonderful to have everyone with us. Mark L, Mickey D, as I told you, Norbert up in the cold country and the beautiful fir trees up in Canada. Partho's a new guy with us. Glad to have you with us, Partho. Hope you're enjoying the Danielcode. Richard's with us, Scott's with us, Peter's with us, Sean's with us down in Adelaide. Trevor, of course, important to have you with us, Trevor, thank you. And all of the others of you that are just straggling in just a few minutes late, folks, but that's fine. You're welcome to be here. So today I'm going to talk to you about time. And I do warn you, this stuff is addictive. I spend a good part of my life looking at time cycles, and if for any reason I'm not working, which usually Sunday's my day off, what I will do is I'll look at time cycles. And I know that, Mick, you're going to be absolutely obsessed with this. And once you start, it's extraordinary. And how good is it? Well, get it right, understand it properly. I don't think you'll ever miss a turn, which is a huge, huge statement to make. But I've been doing this for a very, very long time. And when I make that statement, I'm, telling you with 30 years of experience. It's a big statement, but creating and trading time signals, in my view, is the ultimate form of trading. Now, we've always had a little bit of time involved. The TO3 signals, which is our product that we first started with, are turns, and they're predominantly priced, but they do have an element of time. And if you really want to scratch your head and wonder why the Danielcode trade signals are so accurate and so fantastic, it's, I think, because they have an element of time in them. But you can decide that for yourself. But I'm going to go through and show you how you build these time charts. But don't allow yourself to get bored and go away, please, if I'm a bit ponderous, because it's going to blow your mind when you get near the end of this. So, as we know, markets are rational, orderly, and sometimes predictable, which I guess is why we're long equities and long bonds and a few other seriously good trades as well. Been some drama in bonds this week, hasn't there? And I haven't got the chart to show you, but I just want to point out to all of you that you've seen this chart I've shown you before, where bonds are effectively the government's view of what's happening, or the Reserve Bank's view of what is happening, and the equities is the public's view. As I've been telling you all year, the whole of this correction we've been seeing in equities has been very benign. It's mild. There's been nothing vicious about any of the downside moves, whereas in a serious bear market, you get some really vicious moves, and we haven't seen that. There has been any suggestion of something being vicious, it's all been to the upside. So the greater trading world is not convinced that there's any serious trouble around at the moment, but that may change. Now, do excuse me, in a beautiful sunny Queensland, today is not sunny. Today is cold. Mick, I think yesterday was the coldest 1st of December on record at the Gold Coast. And having said that, it's not seriously cold, but it's a change, and it's very windy. But I think with all the wind, my hay fever has been hitting peak levels for the last couple of days, so do excuse the occasional carumph as we go along. Okay, so let's get moving. We've got lots and lots of stuff to talk about. This is actually a slide from 2 weeks ago, and it's called The One More Thing. And this was a post that I had up on the front page of our website, telling you that if you look at the final couple of lines, the index has bottomed for now, just a few points below the 50% retracement, and that may be sufficient for a while. So that was the 20th of November, 20th of October, I'm sorry, and the market's been up since then. So that's a pretty nice feeling. Let's have a look what we've got. This is the S&P E-mini, and as you can see, the correction from the high, January the 4th, 2022, of course, that correction has been anemic, and all it's doing is correcting the pullback to the March. It says 2022, that's actually March 2021, my apologies, low. That was the flash crash low, you remember. The world was proceeding as if COVID wasn't a problem, and all of a sudden they decided COVID was a problem. And we had that sensational 24-day flash crash, which actually put the S&P into bear market territory if you use the traditional method of a 20% decline in price, and immediately recovered and went on to make massive new highs. But you have a look at that. The first correction we got off our January top here went down to the 44.46% level. That's the Danielcode retracement, 36.37. Hit that almost exactly to the tick. Had a decent rally. That was the big rally that took back 57%, I think, of the move down, and then dropped down to make its final low. That's that October low I was telling you about, at just a handful of ticks above the 50% retracement. So this is a very, very modest correction, and I am not one to prognosticate about the future, other than to remind you that if you're not looking at the fourth seal forecast from Frank DB, you should be. And it's no secret that Frank thinks we're likely to have new highs next year. What do I think? Doesn't really matter what I think, because it doesn't affect me. I just trade the daily signals, whatever they are, and I'm happy with doing that. But interesting to read Frank's commentary. He's a very, very clever chap, and it's interesting that he thinks they're going to have new all-time highs next year. I'm a little less enthusiastic than that, but anyway, we'll soon find out. Here we are. So let's talk about time and finding the signals and what it means. So every bar on every chart has both an X and a Y axis. The X axis is time, that's the one running along the bottom. The Y axis is price, that's the one going up and down the vertical level. Now, the industry is totally focused on price to the exclusion of everything else. And I've never really understood that. I've been using time signals for a long time. I spent many, many years learning how to create them. And I think they're just fabulous. But the general comment you'll get about anyone who talks about even thinking about time is that it can't be done. And that's actually code for I can't do it from whoever says it. A very famous educator and trader at a seminar I went to once said to me, don't talk to me about time signals. He said, if you make 22 hours, if you win 22 hours in your trading, you go to your bank and say, I've made 22 hours. They'll just say, so what? But if you've made 220 points, you can go to your bank and they'll lend you some money. Well, I understood that. And that sort of put me off thinking about time for maybe a couple of years. But I kept coming back to it. And honestly, it is so fabulous. To me, it's exciting. I am obsessed with time cycles and what time does to the charts. That's the big issue. So as you can see here, every single bar has qualities of time and price. And a lot of the people, for example, who are interested in GAN studies, and I know a number of you are, every time you put an angle on a chart, which is the fourth seal, it has qualities of time and price. Okay, so your life, whether you know it or not, is ruled by time. What time did you have to be here today to watch this webinar? What time have you got to go and pick the kids up from school? What time's dinner tonight? What time's the game start? How long have we got? What time have we got to leave to get to the game on time? Our whole lives are ruled by time. Yet, with this most important activity that obsesses most of us, trading, markets, we ignore time. And that's crazy, as I hope to show you today. Okay, so let's move on from here. And as I've said, time cycles have a bad rap in our industry. This phrase, "it can't be done," is actually code for "I can't do it." But you can do it. That's the unspoken part of it. And I mean, Danielcode, we've been forecasting accurate price levels for 15 years. And there are over 45,000 members charts under the chart archive tab at our website since we started this website in 2007. Go and have a look at those charts. You'll be hard-pressed to find a market that's turned anywhere except at one of its Danielcode price levels. So how do we create the Danielcode price levels? We use Danielcode time cycles, and we simply put them on the chart as exactly the same, but price cycles. So we take them from measuring time horizontally to measuring price vertically. And that's the proof that time and price are the same thing on different axes. So think that through. Remember that time cycles themselves are not forecasts. Time cycles are reality. Time cycles are the ones that I'm interested in, and the ones I'll be talking to you about are scientifically based, and they are observable. I'm not interested in getting into astrology at all. This stuff is science-based, and it's measurable. If not by us, it's been measured by experts. And you can find all of these ratios in the ephemeris that's published by NASA Jet Laboratories. And it's an interesting book to have if you don't have one already. Okay, let's move on. So we're simply going to use factual and observable time cycles from our own natural world. Science says if you can't measure it, it doesn't exist, and I understand that. I'm always trying to measure things. And all of these time cycles we're talking to you about today are known time cycles. You can look them up in Wiki or anywhere you like, you'll find them all there. But we also use the fractals of the time cycles, which is something that's a little bit more obscure. If you're only trading price or using the tools that create price, you're missing 50% of the available data. And time measurements are exact and have a physical component. Price turns are basically mass psychology, hence they're saying time is more important than price. So they repeat. Time cycles repeat. Time cycles start, run their period of time, end, and then start again. That's why they're called a cycle. They're endlessly repeating. It's the market's reaction to time cycles that interests us. It's that price action that comes at time cycles that's the flashing light for us. That's what we're trying to learn all the time. And correlation is not causation. Remember, correlation is not causation, folks, but by the time end of this webinar, I know you'll be thinking that it may be causation. Let's move on with that. So let's start with the big cycles. I'm going to take a little bit of time to set these out for you. I want you to understand what I'm talking about, but don't leave early. The banger's in the tail of this thing when you'll see it in action. So start with the bigger cycle that we use. Earth rotates around the sun in a regular elliptical path, and that is where we get our year from. 365 days is one rotation of the Earth around the Sun, back to wherever that starting place was. Modern calendars are set according to the tropical year, and it tracks the time from the spring equinox to the spring equinox, so it goes back to there. Equinox is Latin. It means equal night. So equinox, or equal night and equal day, the time of the day and the night is equal. That happens when the sun, direct rays of the sun, are exactly over the top of the equator. So that's a time that can be measured. We know when these equinoxes are, and we know when they happen. And that's a measuring point. Remember, all these things that I'm telling you about are measuring points. Unless we can measure the start and end of these cycles, we'll never have any understanding of it. So it's important that we do this process, that you can see what these various cycles are that I'm going to show you. So equinox, that happens on the 21st of March and the 23rd of September each year. So here is a big, fancy-looking graph or chart that shows you Earth's solar orbit. And you can see there are times on here where there are points that we can measure. The equinox is the one going up and down, 21st of March and 23rd of September. On those dates, we have equal night, or other words, day and night are equal. Do excuse me. I should have referenced that by saying at the equator. Of course, they won't be equal in the places where we are. Next, you have the line of solstice, and those are 21st June and 21st of December. What's the solstice? The solstice is where the Earth itself is not sitting on a vertical axis. It's got an angle on it, and because of that angle, as the Earth moves around the sun, the direct ray of the sun appears to go up and down the Earth. It doesn't, of course. It's just the rotation of the Earth in its going around the sun. But the furthest north that the apparent sun will ever go is called the Tropic of Cancer, and as the lowest it'll ever go is called the Tropic of Capricorn, and that's the solstice, when the apparent sun has reached the highest state it will go and the lowest level it will go to. The last one to look at here, which is one that's not understood very well, is the aphelion and the perihelion. And basically in this cycle around the sun, it's not a circle, it's an ellipse. So there are times when the Earth is further away from the sun, and there are times when the Earth is as close as it's ever going to get to the sun. And at those points, the gravitational pull of the sun changes imperceptibly. So you can see in some of these movements heading out to the aphelion, which is as far away as the Earth will ever get from the sun, the gravitational pull of the sun, which is there, it's not so obvious to us, but that's why we don't go spinning off into outer space. We stick to that orbit. The gravitational pull of the sun is getting less and less and less until you get to the aphelion. Excuse me, or what they call here the line of the apsides. Might be apsides perhaps. But from there on, the Earth is approaching the sun, and it keeps approaching the sun until it gets to the equinox. And from the equinox on, it's starting to move away from the sun. Now, those extremes of that cycle is called the aphelion and the perihelion. Don't get hung up about it, other than just note that they happen. So what does that mean to us? Well, have a look at this. This is the S&P. This is the continuous chart. And start with the March 2009 low. That was the crash low. You remember the 2007-2009 bear market was pretty sensational at the time. Where did that whole big pullback end? March. What happens in March? Well, one of those cycles we've just been talking about, isn't it? And you can see that same cycle at the first low that came out of the January high this year. And you can see that same cycle at the first reaction to that low. And you can see that same cycle at the low of the 2020 flash crash. As well as that, look at these other dates I put on here. These are all equinox dates. Sun directly over the equator. Some of them are very significant. The ones that look pretty small, I can tell you, they were pretty significant at the time. So is it worth knowing that stuff? I think it is. I think it is. And have another look at this, just refresh your memories as we move on. We're going to look at the next part of this, which is the equinox, perihelion, aphelion, and the solstice. I've explained those to you. Just refresh your memory about them, and we'll move on to see what they do when we put them on a chart. Have a look at this. The high, January this year, the all-time high in the S&P and in equities, was at the perihelion. Exactly. The low from the COVID is now real flash crash was at an equinox. Look at what happens on the way up. You get a solstice, gives you an important bar. You get an equinox, gives you an important bar. All of these ones, the ones that even look small, the solstice, the equinox, as we're going up into the high, and the solstice, one bar before the high, they were huge moves. Absolutely huge. Look at what's happened since the high. We've had a high at the equinox. We've had a low at a solstice. We've had a high at another time cycle, which is not on this chart. And the next equinox is showing a bar that appears to be 2 off the low. The low came almost exactly at the 50% retracement, 34.91 plus a handful of ticks. But the bar that I've highlighted there, that was the equinox, that's actually the closing low of the whole pullback. Okay, so we have chart lows and we have closing lows. That's the closing low, which is really, really interesting. Was it worth knowing that? Absolutely. All of this stuff is knowledge, and it all has effect. Have a look at this. So those are the main solar cycles. Let's think about the lunar cycles. To appreciate moon cycles, you need to take a little test. When I first did this, I went and I filled up 2 buckets of water. I was a bit younger in those days. I probably couldn't do it now. And fill them up with water. Hold one in each hand, straight out from your body, right angles to your body. They weigh about 40 pounds each. See how long you can hold it. I bet you can't hold it for long. And you don't even have to do that. Just pick up a jug or a coffee pot, something that holds a considerable amount of water, fill it up, and hold it out at right angles to your body. See how long you can hold it. Now, that's a bucket. Weighs about 42 pounds, 20 kilos. That's quite a lot. Now think about the weight of millions, perhaps billions of gallons of seawater as the gravitational pull of the moon creates tides. When the gravitational force reaches the shoreline, it doesn't stop there. It creates the same gravitational pull over the land as it moves through. We call these air tides. These tides are real and known about and can be timed very, very accurately. Back in the day when I was a lot more obsessed about trading, or perhaps I was able to stay up later at night, I'm not sure which, I actually got some surveyors. This was in the days before Google. It wasn't really easy to get aerial longitude and latitude in cities. So I actually got some surveyors and asked them to go and give me the latitude and longitude right down to seconds. And I wanted them to take that at the center of the trading floor of the New York Stock Exchange, because that's what we're trading. And we're trading a derivative. The futures exchanges are in Chicago, But what they're trading is the price of the Russell shares, or the S&P shares, or the Dow shares, whatever they are, which are actually trading in New York. So they couldn't do that. They couldn't get access. So I said, well, give me the exact measurements as close as you can to the front door, which they did. And I then calculated the distance and the time it would take the tide to move from its nearest tidal measuring pool, it's called New York Battery, to the center of the New York Stock Exchange. And then I took those tidal moves, and I was trading really, really short-term charts. And it's pretty interesting, folks. Those of you who are interested in short-term trading, take a look at it. It's more than a casual correlation. It's very, very interesting. Don't forget that the quarter tides are lethal. Wonderful stuff. So we've got this gravitational pull of the moon, and anything to do with lunar always sets off a few comments about lunatics and other times. This is just simply science, straightforward. And this is what happens with the tides. You can see the gravitational pull. I thank Shutterstock for this. I don't think I paid them. I hope they don't mind. But you can see the gravitational pull of the moon creates this huge bulge around the whole Earth on that side. And the other side of the Earth also has that bulge, which it has to. That's hydrodynamics. You have a high tide on one side, low tides in between. The default will be you must have a high side opposite it, which is exactly what happens. But these tidal movements are real, and they are absolutely huge. And those of you who are more interested in this stuff, have a look about all the wonderful things the moon does for us. It's the moon's gravitational pull to a large extent that keeps Earth sitting at its, I think it's 5 or 6, 7 degree offset axis. If we didn't have that, we wouldn't have the Earth as we know it. There are all sorts of things that the moon does. It's our permanent satellite, but it's a very loyal satellite, and it's a helpful satellite. It's doing great things for us all the time. So this is a wave at Cape Town in South Africa, just to show you the sheer force of what the moon, gravitational force of the moon can do. And that's happening continually all over the world. It just goes on and on and on and on. And the sheer power, once you've taken the test of holding up your bottle or holding off your jug out at right angles, as I asked you to do, you'll appreciate that this power is real and it's awesome. And these tidal ranges can be huge. The actual tidal range is really not only the tide, it's a function of the seabed and the landscape around it. But the highest tides in the world can be found in Canada at the Bay of Fundy, and the range is 53 feet from high tide to low tide. At spring tides, you have spring tides, which are big tides. You have the NEAPs, N-E-A-P-S, which are the small tides. And they're a function of where the moon is. If it's somewhere near perigee, that's the most powerful part of the cycle. If it's somewhere near apogee, which is the other side, as far away from the Earth as it's ever going to get, you get smaller tides. Interesting stuff. So the first two major time cycles that have got me entranced and have had for many years. The first is the apogee-perigee cycle. So in the moon's orbit, I've showed you a picture of that, I think. If not, it'll be up soon. In the elliptical orbit, it's not equal. It's an ellipse, and it's longer at one side than the other. So apogee occurs, it's the measurement when the moon is at its maximum distance away from the Earth. The perigee occurs when the moon is at its closest to the Earth in its elliptical cycle. And the moon is moving at its maximum speed around perigee. The second important cycle is the new moon, full moon cycle. And that's important because the reason we get different views of the moon is because of the different position of the moon relative to the Earth and the Sun. The new moon occurs when the moon, which is our permanent satellite, is directly between the Earth and the Sun. So in this position, the gravitational pull of the sun and the moon combined, because they're in the same direction now, creates the maximum gravitational effect. The full moon occurs when the Earth is directly between the sun and the moon. So in this case, the gravitational pull is split both ways. Sun has a gravitational pull. It's roughly 157 times the moon's gravitational pull, but it's so far away that gravitational pull of the sun is greatly diminished. But when you have them in line, the moon, Earth in one position with then the moon, then the sun, moon and sun on the same side of the Earth, that's maximum gravitational pull from the moon and the sun. And at the full moon, which most of you are more interested in, it's the opposite. The moon is on the opposite side of the Earth to the sun, so the gravitational pull is diminished because it's pulling two different ways. So here's a graph of the apogee and perigee, which perhaps I should have shown you a little bit earlier. And you can see from the ellipse pattern at perigee, that's as close as the moon's ever going to get to the Earth, and that's its fastest velocity as it's moving through space. Equally, as it moves out to its apogee, that's its slower speed, and you can see the changes in directions, what I'm talking about. From the perigee, that's as close, that's the maximum gravitational pull that the moon exerts on the Earth. Then as it moves in its cycle, it's moving away from Earth. So it's moving away and its gravitational pull is getting less until it gets out to the apogee. That's when its gravitational pull is at its weakest. And it turns around, and as it's made that turn, it's coming back towards the Earth and its gravitational pull is increasing. And it gets maximum at the perigee. What I'm interested in is that it's the changes in, what's the right word, quantum of the gravitational pull. I mean, you couldn't measure that. You'd need some very, very advanced instruments to actually measure that. But it's observable. And you can see it's logical that as the Earth is moving away, as the moon, I should say, is moving away from the Earth, its gravitational pull is getting less and less until it gets to its apogee. When it makes a turn and it's now approaching the Earth, it's getting stronger and stronger, and its speed is also increasing. So it's at maximum speed and maximum gravitational pull at the point of perigee. So this is the second part of the cycles. Don't get held up on this. This is simply showing you that at the new moon, you've got sun, moon, Earth, moon and Earth in the same line, and that is giving you the maximum gravitational pull on the Earth. The bottom diagram shows you the situation at full moon. The moon has now moved around. It's on the other side of the Earth. So you've got the weaker gravitational pull from the sun on one side of the Earth and the stronger gravitational pull from the moon on the other side of the Earth. And both those two are fighting each other to some extent, but they're certainly not enhancing each other, which is what you get at the new moon, which is why the new moon is a very important marker. So you can read through this stuff. It's all what I've just been telling you about. And it's the changes in the level of the moon's gravitational pull that we use as measurable markers. Okay? We have to, for any cycle, we have to be able to identify when it starts and when it ends. And that's what I've been telling you about here. Does any of this matter to us as traders? Let's put it on a chart and have a look. Here you are. This is the S&P E-mini for 2022. Have a look at these perigees and apogees. Remember, as I'll show you in the next couple of bars, slides, these time cycles are valid to plus or minus 2 days, mainly, sometimes 3. Why is that? Well, we'll come to that. It's because of the holidays and the weekends that we don't have every daily bar on these charts. But just have a look at the preponderance of times the apogee or perigee is near a high. 1, 2, 3, 4, within a couple of days, 5, 6, 7, 8, not that one, not that one, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 at least, have been right near the highs and lows. Let's have a look at this last price movement from October on. Perigee at the high, perigee at the high, apogee at the high, perigee at the high. Little apogee is a bit hard to see between just after the October low. There is an apogee and there's hidden in amongst the charts a bit, but it's 1 bar off the high of that rally. So there's obviously a huge correlation between apogees and perigees and market extremes, market highs and market lows. Not all of them, but the vast majority of them. Does that mean something? You bet. Let's have a look what happened last year. Never take your latest new discussion and put it on the recent chart and say wacko. Go back, look at more data. We don't want to be using insufficient data. This is now taking in the whole of 2021. What you've been looking at was 2022 year to date. Have a look at the apogees and perigees. Look at their affinities to highs in particular. Even when the market's correcting, the rallies go into an apogee, the rallies go into a perigee. Okay? Interesting stuff? Certainly is. Certainly is. You will need to know about this stuff, but that's only the start of it. Let's move on further. So, apogees and perigees give market highs and lows within a few days. This is just simply a blow-up of the last few months of trading in the S&P. Those of you who follow the Danielcode will know that we haven't missed a turn in the equity markets this year. Not one. And I'll show you how we got some of them. All of these markets are running off known time cycles or fractals of known time cycles. And if you're interested in this stuff and you enjoy this webinar, let me know and I'll teach you how to do it for yourself. Have a look at this. Look at this run up from that October low into a perigee, that's a high, then into an apogee, that's 1 bar off the high, then into the current high we had a few days ago, there's a perigee. Why did we manage to get long on this huge up bar here? We had buy signals. There was a time cycle right at the low. This hasn't got today's bar on, incidentally, folks. This was done at 4 o'clock this morning, which would have been about 1 o'clock in the States, in the Eastern States at least. Okay, let's keep going. What are the other things that affect cycles? Well, we talked about the new moons and the full moons. Have a look at this. These are the new moons. They're a little black dot. The full moons are a little yellow dot. They're even harder to see, for which I apologize. But the new moons are pretty obvious. Have a look at the affinity of the new moons to the market highs, plus or minus 1 or maybe say 2, possibly 3 days. At the high, it's got it. Next rally back high, it's within 2 days. Next high, it's within 1 day. Next high, it's 2 days late. Next bar high on the day. Next one in June, early June, right at the high. The next high in July, right at the high. The August high didn't really register. We got a minor high there and a 2-day correction. And the high in late August, early September came on a different number, which I'll show you. And then the kickback rally high straight after that, straight up into a new moon. Down it went straight up into 1 day off a full moon. Okay, nothing much as you can see obviously around the October low, but I'll show you how that low came in at a precise time cycle. And since then, the minor high right at a new moon, the next high right at a new moon. Remember the apogees and perigees I showed you in the previous chart. They are working all the time as well. It's not just what we have on this chart at the moment. Okay, let's move on. So if all the highs are coming at new moons, or the vast majority of them are, what's giving us the lows? Well, the quarter turn. These are called quarter turns in the moon cycle. I know this is hard to envision. I haven't got a picture to show you, but think of the moon in its new moon position, that is between the Earth and the Sun. All directional gravity is working one way. From there it moves around to the other side of the Earth. So when you get to a full moon, you've got the moon on one side of the Earth and the Sun on the other side. They are opposed in their gravitational pull on the Earth. In between getting from new moon to full moon, they go out on their spherical orbit. They hit a point just like the apogee and perigee. It's a different cycle, but it works the same way. They hit a point at which they've been going away from the Earth, and they make a turn, and they're coming back to the Earth. Those positions are turns of what's called quarter moons. 1 is the first quarter moon, 3 is the third quarter moon. In other words, if you like to equate them just mentally, they're the apogees and perigees of the alternate moon cycle, the full moon, new moon cycle. They're the points at which the moon is changing its gravitational pull from getting stronger to getting weaker, and from getting weaker to getting stronger. It's the point that that cycle is turning. Okay, pretty dynamic, isn't it? The 3s are very dynamic. You can see they're all near highs and lows. Pretty interesting stuff. Yeah. Yesterday's big bar up on a first quarter moon cycle. Easy stuff, wasn't it? Okay. Let's see how you create your own time turn signals. We are going to start the simple stuff here. We've got a chart here of the S&P, and it's showing apogees and perigees. Now remember that we've got 2 days a week that are not shown on these charts, and we have 10 more days during the year when there are public holidays. So at best we could hope for these things to be accurate to plus or minus 1 or 2 days. The fact that they are so incredibly accurate is what makes all of this so extraordinary. If you go from the left-hand side of the chart looking over, the first perigee came 1 day after the low before that big rally up. The next apogee was 1 bar from the high. It was actually the closing high of that little rally. The next perigee, again, it was 1 day from the chart high, but it was itself the closing high of the rally up from October. Then you get to the next apogee, is 1 day away from the closing high of that rally. If you take that apogee, and you know that the first of the Danielcode numbers is 29.6, which is almost exactly the same as what's called a synodic month. In other words, a synodic month is the length of an average calendar month. Danielcode time is 29.63. Synodic month time, which you can look up in Wiki or any other encyclopedia, is 29.55. And we don't have to use the numbers after the decimal points for time cycles because we have the inexactitude of 30-something% of the bars not being on the chart because they're weekends or holidays. So all of you who don't like decimals, you can say, let out a big sigh of relief. You don't even have to think about them. 29 is close enough. Half of 29 is 14. Twice 29, 53. They're the major dominant Danielcode time cycles. They also create the price levels. Have a look at this chart. 14 days from the apogee gave us the low. That was the low I said you wouldn't see on that particular chart. Look at the notes up the top. The perigee itself and the next apogee and the final perigee give you the highs. The perigee in October, maybe in mid-November, is right at the high. The apogee of the next bar is 1 bar before the chart high. The perigee for the next bar is at the chart high. How accurate is this stuff? It's just whacking away all the time, isn't it? Is it worth knowing? You bet. Is it tradable? Once you learn it, it's perfectly tradable. So I think we need to move on to the next one, which is here, more moon cycles. Okay, same thing. Don't get freaked out. Most of this is just, I've just shown you the later parts of it. I've gone back a bit earlier now to show you time from the apogee straight after the high in this the 59% rally. Time from that apogee, or 29 days is Danielcode time. There you were. That was the high. Look at the further down the chart. Gold cycle is 44. If you don't know why gold cycle is 44, go to, please, our articles tab and look at the article there called It's Time Trading Gold, and show you why 44 is the cycle for gold. But it also appears on all other charts as well, just not as frequently as it does in gold. The 44 cycle from that same apogee, that gave you the low before the low. Very important. One day before the perigee itself. Move on. The apogees and perigees give you the highs and lows all the way through. The next low, the important low in November, was 14 days from the apogee. The big high, soon after the September high, was 29 days after the apogee. In other words, these apogees and perigees, apart from being significant turning points themselves, are anchoring themselves so we can use the Danielcode fractals from their time to create signals for the other bars' time cycles. Okay, so here we are. There's that offset time cycle I was looking for there. It's 1 day off, 59 from an apogee, from a perigee, I should know the apogee before the perigee. I'm getting myself confused here, but do excuse me. 59 days from the apogee before the perigee near the high, that gave you that low. It's not the chart low. The chart low came the next day. It was a closing low. It's the closing low or the velocity low of that whole move down. The next day you got that big outside day. You'll remember there was something weird about that. There was a massive bank of options, an options barrier they called it, 3,500 or thereabouts. And the market dived down into that, let all the options guys dirty their knickers or whatever they do, and then it rallied and turned. But it gave the momentum high and the closing high right on the 59 days. And from there it's just run up into its apogees, into its perigees, into 14 days from the apogee gave the next low, 29 days from the apogee actually gave the perigee and the high. Excuse me. Have a good look at all of that. Pretty extraordinary, isn't it? Here we are. Does this work on other markets? Well, let's have a look at a Forex chart. This is the Aussie US dollar pair. Apogee at the high, perigee at the low, apogee 1 bar off a high, perigee at the little counter trend high 1 bar before the low. Allow it 1 or 2 days variance, it's at the low. Apogee on its way up, okay, just caused a small counter trend. Perigee 1 bar off the high. Apogee 1 bar off the low. We're going down the chart now. Perigee at the next low. Apogee 1 bar off the low that gave you a 2 bar counter trend. Perigee at the high of that whole 4, 5, 6 bar consolidation. Apogee 2 bars after the low. Perigee 1 bar after the high. Apogee 1 bar before the high. Perigee, I think that actually is the high. But if not, it's 1 bar with 1 bar after the closing high at least. So here is just a totally simple chart. Aussie US dollar pair, you can take any one you like. They're all the same. They're all dominated by these time cycles. Here's the explanation about variances. 365 days in a calendar year, 255 trading days. We have 52 weekends, means 104 bars are not on these charts. There are at least 10 CME market holidays. Trying to work out if Juneteenth is actually a holiday or not. It's shown on the CME schedule. It's certainly a Friday holiday, but a whole lot of people that I know didn't observe it. Anyway, good day for playing golf. It's always a good day for playing golf. So almost 32% of daily bars are not on these charts, and that's what causes this variance, because we don't have a totally accurate count, plus or minus days. As well as that, of course, these are 24-hour cycles. They can be very late on one day, effectively happen on the next day, etc. Okay. So time signals vary by a few days. This is another Forex chart. Just pick this at random. I want to show you how accurate these time cycles are. And you can see that we've got a perigee, and I've got a vertical line through it, which is the start of the Danielcode time count. You can see it's 44 cycle from there, the red one. That's gold cycle. We always have it in red for the Danielcode charts. Right at 44 days, that gave you the high of that rally move in there. The next cycle was 59. That gave you the next high. The next cycle was 70. That gave you a minor high. Okay, and you can see all these cycles are running from a perigee. Okay, once you know these markers, you can start your Danielcode time charts in fractals from there. Have a look at silver. Silver loves lunar and DC cycles. Mickey D and I have a chuckle every time a full moon's near, because we're saying, man, turn in the S&P and silver. Silver loves the moon cycles, and does the S&P. Well, have a look at this. This is the silver chart, COMEX silver. Start off with, what are we starting off with? Well, the light blue, the line going up and down, is starting from the third quarter. Remember I talked to you about the quarter cycles, which are sort of the apogees and perigees of the lunar new moon, full moon cycle. They're the points where the satellite, that is the moon, is at its furthest point away from Earth that it gets in its new moon, full moon cycle, and the closest point that it gets to the Earth in its new moon, full moon cycle. The ones with a number 1 on them, the first quarter, they're far away. The third quarter, 3, is the near one. So we've started this standard Danielcode time cycle tool from a third cycle. Look what you get. 44 days gives you 1 bar before the low. 62 days from the third quarter gives you the low. 59 days from 1Q, that's the line before the black line. It's a black line. You can't see the 1 in there, it's a bit masked, but that's the first quarter, and 59 days from that gives you 1 bar before the high. Okay, the 70 cycle gives you 1 bar before the closing low of that move. Moving on from that, you've got a new moon on that. You've got a perigee on the next big high up there. You've got a 3 cycle 1 day after the low. There's also an apogee there. Then it runs up. The moon gives you the 1 bar counter trend. The perigee gives you 1 bar past the high. Get up to near the high of this chart. There's an A and a 3 there. A for apogee. 3 is telling you that's the third quarter. The A apogee is the closing high of that whole move. The 3 is the start of the first push down. And then you've got a new moon and a perigee, both of which turn this market down for 2.5 days. Okay, the 1 cycle kicked it up, away it's gone, roared up, and again today, more. Wonderful trading. Okay, so hope you've enjoyed that, folks. If you have enjoyed it, and you'd like to learn how to create the time cycles yourselves, it's not as complex as it looks, because I've already created the tools that set all of these turns out. But if you are interested, do send me an email, jneedham@thedanielcode.com, and I will be happy to talk to you about learning how to create and trade time cycles. I can assure you that's the ultimate way of trading that I am aware of. So basically it's all good news for us. There's no inflation in trading futures and Forex. Markets pay exactly the same going up as going down. Interest rates only affect T-bond traders, and trading in T-bonds is just fabulous. Okay, so drama and fiscal catastrophes just add volatility. Volatility is our lifeblood. So be happy, learn to trade the Daniel Code now, and you'll be even happier when you see that you now understand what markets are going to do before they do it. And that's us for today, folks. It's our normal show you that we have free trials if you haven't already. Please go to the Danielcode website, www.thedanielcode.com. Start your free trial. If you've already had a free trial, the computer may well remember you and not want to give you another one. In that case, simply contact Terry at support@thedanielcode.com, and he will be happy to enable your free trial. Finally, is our standard disclaimer and disclosure. It is very easy to lose money trading futures or Forex if you don't know what you're doing. Please make sure that you understand what you're doing and that you are a competent trader before you risk real money. I think losing money trading is just absolutely ridiculous because it's not necessary and it's not required. Okay, and that's us for now, guys. And hope you enjoyed it. Jeff, I'm glad you did. And a lot to think about, isn't it? They're there every market, every day. Never going to stop. And Chip Stevenson just here as well. Good to hear from you, Chip. Hope you're very well, my friend. And your big mate as well. So, folks, thank you for being with me. I hope I've given you something to really think about. And you can learn this stuff. I can teach you this stuff. You will never be amazed again. You'll be amazed at what happens because you knew it was going to happen. But you'll never be sitting there saying, I didn't think the market would do that. You will have a very high probability feel for what the market's going to do and when it's going to do it. And that's the essence of great trading. Bye-bye for now. Thank you for being with us. Very much appreciated. Bye-bye for now.